If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Sean Winslow. Let's dive in.
Hey, Aryeh, welcome to the show.
Thanks for having me, Sean.
Hey, no, thank you. I know you're a busy guy, and I appreciate you taking time out of your schedule, especially near the end of the year. Things get crazy for everyone this time, so I really appreciate that. But to start out, let's get into a good origin story. What's Aryeh's background? You know, what led to where you are today, and what are you actually doing today?
Sure. Yeah. No. I probably don't have like the, some people may say the origin story is like amazing, and some people may say like, oh, that's like so standard. So I'll give it to you, and then let everybody else judge. Grew up. And I guess I didn't realize how entrepreneurial I was as a kid. I kind of took certain things for granted. I love playing sports, but I also, back then, I was a pretty big sports card collector. And that was kind of like my first stock market, unbeknownst to me. That was pre-internet days, so I'm dating myself a little bit here. But the price guide would come out for the value of the cards, whether it was football cards, baseball cards, basketball cards, whatever it was. The price guide would come out like once a month. And so in between, you had like a period of like stale pricing, meaning like it was stagnant, right? Like whatever the price guide said is what a person would be, a willing buyer and seller would probably transact on. And if you went to a card store, like it used to be, like they would say, we sell it at book value, right? So whatever the price guide says, or maybe a little bit below, but they never paid. If you want to sell them something, they would never pay more than half book. So if it was a $10 card, they would never pay more than $5 because they want to mark it up to 8, 9, or 10, or whatever it is to sell it in their store. And what I started doing was realizing that like up and coming players who were doing well, but the guide was behind the curve, so to speak, that, he's having an amazing in May, June, July, but the guide's not coming out for another 3 or 4 weeks. You have this window of opportunity to start purchasing the cards below market, because that the next time that guide comes out, there's going to be like a little up triangle next to it, indicating that the price has gone up and it's going to be a new price. So it's kind of like arbitrage in the card market was really how I was dealing with it. And, if I saw a player, not playing well or just was overvalued or overhyped, I'd probably trade some of those for an upcomer who was actually really performing well. And by the time I was like 15, I was actually going to shows. I remember when I was like 12, 13, my dad would drive me to like these baseball card shows that were like in like hotel lobbies and what have you. By the time I was 15, I would buy a table, because you used to that was how you rent a table and you showcase your stuff. I was having, the table, and I was the seller. And I remember like the first or second show that I did that, it was kind of, I realized like, hey, how I get a lot of my inventory, so to speak, how I buy a lot of the cards are at these shows. I find like where the pockets of, gap of value was. But if I'm behind the table selling, I couldn't do that. So the next show, I basically hired a friend to come with me, and he would sell at the table, and I would kind of and I'd be there with him, but I would kind of wander around, so that way I could go and pick up stuff from other dealers as well. But then, I went to college, and the idea of doing, this kind of thing wasn't like a full-time idea to me. It was kind of like a hobby that made some money, and like I enjoyed and had a great time. I think I remember I got freshman year, I was like, I'm going to be a lawyer. That's what I'm going to be. I love the nuance and all this stuff. And I remember freshman year, I had this professor who had gone to Columbia Law School and was not a practicing lawyer, never practiced a day in his life. And he said, do you like to read a lot? I'm like, I like to read, and he says, do you want to read the same thing over and over and over? And he starts giving me all of the negatives about being a lawyer. And I'm like, no, I don't, none of that, is interesting to me. And he's like, you're not going to be happy as a lawyer. Don't do it. And I basically pivoted to becoming a finance major, and it was the best thing I could have ever done for me, because it made me realize all the things I liked about cards and lots of other things that I had been doing just was spoke to me. And at that time, I think it was still not really, the word entrepreneur was not even in the everyday vocabulary. Whereas now you see that everywhere in anything. Like you ask, a 12-year-old today, what do they want to be? Like if it's not a YouTube creator, it's probably like an entrepreneur or something like that. And so that wasn't like a thing. So I went down the path, went to, got my finance degree, went to Wall Street, went to JP Morgan, started an investment banking path. And then more or less, like almost out of the gate, I realized that like there was something else I wanted. So I started doing things on the side at night, like before it was even called like side hustles. I actually went back to my roots in sports cards because the market had evolved so much. And I started selling, I was really like buying on eBay boxes of sealed cards and then was flipping them onto Yahoo auctions and elsewhere for the spread. And then I started realizing like, hey, why should I take ownership of it physically? Because it was just taking time and money. I had the seller I would buy it from, hold on to it. Then I would sell it on another marketplace and have them just ship it directly. So it was like almost early days drop ship that, kind of like, and then I got into wholesale. I was buying by the case and started growing that business and ultimately got into totally other products and started a bunch of e-commerce businesses. But this was always like at night or on the side type of thing. So my career though, went down the path and was doing early stage and like after I left investment banking, doing early stage venture investing and private company investing, and have worked at some of the greatest private equity firms and hedge funds for, a couple of decades already and really enjoy that. So along the way though, you kind of like say, hey, what do you like? What do you not like? And, found real estate investing, recognized that there was a lot of things you could do both actively or passively, and kind of took my interest and then continued just to learn about investing, whether it was stocks and now crypto and all this stuff. It's always, I guess, intellectually curious kind of has led me down the path and tends to be exploring financial things.
That's awesome. I feel like a lot of entrepreneurs have that curiosity, and that's what kind of drives that success among a lot of other things. But without that curiosity, I feel like there's, whether it's curiosity or just, having that drive to try new things and not be afraid of them. To me, seems like a lot of success stems from that. But in terms of your origin story, that was phenomenal. I don't think that's very standard. I know I used to mow lawns and shovel snow. I think that's pretty standard. That was kind of my origin story into entrepreneurship. But no, that's phenomenal. So today, you have your own business, correct?
Yeah. So today I have a few things. I have my own business. I also have another full-time job that like I work at a consulting firm.
Oh, okay.
For private equity firms and hedge funds, but I do have my own business today as well. Yes, and
That's
that
awesome.
is a large part.
Let's jump into that. What does that entail?
So one of the things that I found, like once I got into the online space of selling and just, it was so different when I started getting into online retail or whatever people want to call it, e-commerce broadly. What I learned was it was so different than, traditional businesses in the sense that email marketing, now all digital marketing, whether it's Facebook ads or, other ad platforms, Google ads, and how you're going to drive traffic and really owning the customer relationship became really important, and understanding like, okay, what is the value of your customer? How can you as the business owner add value to them, but also maintain that relationship? So I got deeper and deeper into that. And I guess, again, intellectual curiosity, I may not do the marketing day in and day out in the sense of, the ads or any of these things, but I love the psychology of the marketing and what triggers people to do different things, how to get people understanding the strategy of that whole thing. And so as I kind of explored that, I started to network and meet a lot of online business owners or, small business owners, entrepreneurs, in different kind of niches that they were seeing success, which was amazing. And now in today's world, it's so amazing what you can do with, think back 20 years ago, what you couldn't do, even 10 years ago, like what a phone is capable of doing in terms of like running a business remotely. And so I met a lot of these people, and what was happening was some people were like, hey, can you teach me Amazon, or can you teach me this? And I was like, yeah, sure, no problem, whatever. But the thing that everybody kept coming to me over and over and over again was, I'm making this money but I don't really know what to do with it. Or I got scammed because some dude told me to do this, or, I didn't know what I was doing, and I didn't know what I didn't know. And I thought like I'd just buy a house and no big deal, and it would work itself out and it'd be amazing. And no, it turns out I need tenants, and then the toilet broke, and then the roof broke, and, like all these things. Right. And kind of like through my own trials and tribulations experiences, and through my professional career, I'm like, oh, let me help you. And I just started originally just like telling people, oh, don't do that. That's a terrible idea. Here's why it's a terrible idea. Or, well, that's okay, but just think about long-term, what do you want? And I think that was another thing I recognized, that a lot of people they have this idea that they want money, right? Like if you ask people like, what do you want? They're like, everybody wants money, but really they probably want the freedom. They want the future. They want something that the money is going to give them. And so I started to just help people like see that picture, and then actually start to systematically build a roadmap for people to kind of figure out what to do. And so now really that's what the business does, is like we help entrepreneurs either get a roadmap or get access to investments that they can think about from a passive perspective, where they don't have to focus on, they're focusing on their mission, they're focusing on their business, whatever they're doing, but they know that the money is growing for them and they can touch it and feel it. So it's not like we don't actually actively manage the money for them, but it's much more of an advisory type of thing. And then simultaneously, a lot of these people, as they're seeing success, they can probably get additional help in their business in terms of how to make it more valuable, how, if they want to sell it, how they can, drive the margins better. And so we do a bunch of that as well.
Oh, that's awesome. There's so many good points you just put in there. And one, I think a lot of entrepreneurs get that like shiny object syndrome. And like you said, they want to make money. So they're thinking of like, oh, this guy's making money doing this gal's making money doing that. Like I need to do that. And you just need to focus on, well, one, I think you need to focus on getting really good at one thing. And then once that's self-sufficient and can run, then you can go do other things. But two, like you said, I think you need to think, yeah, everyone wants money, of course, because that creates that financial freedom, that time freedom. But I think we need to think further out. Like once we have that money, what do we want? Like, what is that life that we want? And then I think then you back into it, and that dictates what you need to do on a given day to obtain that. And so I'm really glad you brought that up. But I'd love to get more into like the business side of the consulting that you're on, because I'm a business owner. And like you mentioned, like at Greenbrier Capital Group, my business, what we do is we help those that want to invest in apartments, invest in large apartment complexes, but either don't have the know-how, or just that they don't want to invest the time into doing it, but want to invest. And so we give them opportunity to do so, where it's a hands-off approach. They're limited partners. They provide capital. We provide them a return and all the benefits of that asset. And so that's clearly, I see what you advise people to do. They're very good at what they do, but, want to grow their money. So I'd love to jump into that specifically. Like I mentioned before, I've listened to a few of your episodes. He has a great podcast, by the way. It's called Inside the Lion's Den, correct?
Yeah, correct.
Great episode. I think great podcast. Everyone should go check that out. I listened to a few of those, and then also just did a little research. And there was one topic I loved that I came across, and that was, starting versus buying a business. Obviously, people are in different situations in their life, or just they're different people that, one thing works better for the other. So I'd love to kind of get into that, and then maybe further as we go, kind of like how to effectively grow that. And you mentioned like eventually people want to sell. It's kind of like what we do with apartment complexes. There's key steps you need to take to be able to make that sale profitable. I know I just put a lot of that, but I'd love to jump into that.
Okay, no, that works. So I think the easiest way to think about, let's start with the buy versus build question, and we'll kind of take it from there. So if you're an existing business owner, right? Like you have your business, you have whatever it is, whether it's a consulting practice, whether it's a delivery, whether it's physical goods, whether it's logistics, it doesn't really matter. But naturally, what tends to happen is the first question I always ask people is like, what do you ultimately want, right? This goes back to the whole money question. And that's like your point of like the future. And one of the things I've learned that it was so lost on me is a lot of money ideas and culture comes from your upbringing, right? Like obviously, like everything comes from your upbringing, but what I didn't realize is some people naturally think about the future, like what do they want and when do they want that future? And then some people, like that's not even in the thought process. The thought is like, okay, I need to pay my bills this month and I just want to do something that's going to give me an extra $100, $1,000, whatever it is a month, right? And so if we're a business owner, a lot of times we listen to people who tell us we have to grow, we have to grow, we have to grow. And I think the first question is just like, do you need to grow realistically? Like from the perspective of like, what does that do for you? Because there are certain zones in businesses that are like what I call the sweet spot. And you can be more profitable in that sweet spot than if you kind of like try and grow to this next level. There's something called like the rules of threes and tens where things tend to break. So if you grow, let's just say from like, $0 to $1 million, okay, there's a ton going on in that zip code. Okay. But when you cross $3 million, typically there's a tipping point where certain things that worked to get you there, they won't work anymore. They're just gonna, like, there'll be new roadblocks. Those things will fall apart because you're too big. The scale is too much for some of these things, whether it's automation, whether it's staff, all different things. When you fix that and you kind of get through the woods there, when you head to 10 million, when you fix it, whatever you fix at that 3 point should get you to about 10 without too many new, like sudden surprises. When you get to that 10 mark, all the things that got you from 3 to 10, they're going to like start to stretch and some of them are going to start to break. And if you're going to try and grow again, there's going to be new things you have to do. So like at these 3s and 10s tends to be like these breaking points. And a lot of people, like you get to that, let's say $2.5-3 million mark, you may be more profitable there and more enjoyable there than trying to push to 5, because like that 3 to 5 zone, it could be pretty muddy and pretty dark. And I'm not saying people shouldn't do it like 100%, but you have to start to like learn yourself and really understand like economics of your business. What do you really want? Do you want to be able to, and everyone's different, right? Like, and I'm not saying one is better than the other, but like, do you want to be able to tell your friends you have a $5 million business, or do you want to have like a pretty comfortable life and, not stress about things? Or are you like, no, I am changing the world. I need to get to $500 million. So this talk about stopping is the dumbest thing I ever heard. Right. So a lot of it is like your inner person that you have to kind of like learn. And I know it sounds like woo-woo-y, but you have to like kind of like get into that kind of stuff, because like that's why personal development is so tied to entrepreneurship, because part of it really is your journey of kind of understanding like what really makes you work. Because if we're going to try and make your business more profitable, that may be way more interesting to you. And the guy next to you is like, I don't really care today about my profitability. I want to be the next, Bill Gates. I want to have the next Apple, whatever it may be. And so the mindsets are very different. And that's why just because someone creates a startup, raises, tons of venture capital money, it doesn't necessarily make them any better than the guy who's kind of like got $1 million business and is totally happy with it. And I think that's what a lot of people grapple with when doing that. So in terms of the build to the buy, like extrapolating all that and putting it in the build to buy, it now says, okay, I have a business. Naturally, if I'm trying to grow, am I trying to grow with new product, new service, new offering? Or am I trying to grow by expanding what I have to new customers? Or do I want to take my customer and have them spend more with me? Right. So like it could be one of 3 things, in the sense that like I don't have to offer new services. I don't have to get new customers. I just have to have my customer buy more from me. Or do I need new customers? Or do I need new services for both new and existing customers? And once you decide which avenue really fits you and your business, then you can decide like, okay, do I need to create these things from scratch, or can I buy them? Do they already exist in the marketplace that of a good service? Meaning like, if there's a crappy service out there, okay, I'm not saying to go do that. But if you think like there's a need, I provide service A and complementary service is service B. Do I need to offer that myself, or can I go buy an existing service and kind of grow my business that way? Now you could do that all the way at ground zero and say, do I need to start the business, or can I just go out and actively buy it? And again, that starts to go into like a little bit of you in the sense, like some people are starters. They're really good at starting things, but they're not so great at the execution and scale. And then other people are really, really good at execution and scale, but they can't start things. And that also talks to, should I buy it or should I build it? And I'll kind of take a pause there because in case you like want to interject a question or whatever, impatiently listening.
No, that's great. I think it hits again on what you mentioned previously. It's like, what do you want in life? Because both of those things, or all of that, is going to take a different type of capacity, different type of time commitment, and willing to do things. And I've always found it interesting what you mentioned in the beginning. Going from 0 to a million, maybe to 5, and 5 to 10. You're right. It's completely different. It takes different processes and systems, different people in place. Do you kind of see more failure in one of those aspects, in one of those segments, more than others, or is it kind of just across the board even?
So it's interesting. I think you probably see more failure in 0 to 1.
Yeah.
As an overall process, but the 1 to 5, what you generally see is more people, what I would say, like where they want to burn it down. They've gotten to the point, but they're so unhappy with it that the business isn't per se failing or not. It may be failing in the sense of profitability. And it may be failing in fulfillment for the individual. The customer may not be feeling like there's a failure going on. They're getting serviced. They're getting the product or service or goods or whatever it is that they want. The business owner and employees, though, may not be ecstatic. Like it all depends on how we're defining failure. So like in terms of like that 1 to 5, I definitely see a lot more frustration and burnout. When you're at a business, though, let's say 20 million, 50 million, 100 million, the failures are obviously the numbers of failures decline. But at the same time, when those fail, they're much more spectacular. I mean, like,
right.
like when something falls off a cliff there, it's kind of like the accident you're trying to look away from, but you're like, I gotta watch type of thing. So it really depends on like what you're going for. The 0 to 1, though, those failures, a lot of times, I think the important lesson in entrepreneurship is, right, like failure is not a destination. It's just like, it's kind of along the path. It's usually that stepping stone to the next thing. As long as you actually learn something from it. Now, granted, if you lose other people's monies, that's a whole different discussion. Mm-hmm. But like, if you are like, this failed, okay, it's very hard in the moment. But if you can start to like really look at like what worked, what didn't work, why didn't this work, what did I do wrong, you'll gain a lot. Like some people, they're effectively failing on 0 to 1, but they didn't care. Because they're like you said earlier, right? Like it's this not super afraid to try things, or the curiosity of doing it. And then other people, though, who get into businesses, they have the money beforehand, or they have an investor or whatever it is, and so they don't feel the same. Like they go and they overspend because they have the money to do so, and they end up failing because they outsourced or offloaded so much instead of like grinding some of that out. So I think like it goes back to really like what the person deep down wants, mm-hmm. And where they're trying to go. So in terms of like buying businesses, I think one of the benefits of buying a business, whether you have an existing one or you're at 0 today, you're at ground zero, and is if you're buying something that's already existing, you now know, like if you're not a launch pad person, right? If you're not like, I don't even know how I'm going to get my first customer, that's solved for you. And if it's cash flow positive and if it's profitable, then again, now you have something that it's a living, breathing thing. Now, granted, you may have employees that you have to kind of look out for in the sense of like keeping them employed and paying payroll, but now it's a function of like, okay, understanding how this person does this, and then how do you kind of take it to that next level. And in today's world, I think that was the other thing. Like acquisition was this foreign concept that was left for the investment banks or the private equity or the big corporations or whatever it is. Like your neighbor never said, oh yeah, I just went and acquired, another dental practice. It wasn't common. Or, in real estate or in business, like, hey, I acquired another e-commerce brand or whatever it is. It wasn't like the normal conversation. Like most of the people had 9-to-5 jobs, and like very few people dealt with mergers and acquisitions. That was in the newspapers, blah, blah, blah. Whereas now, first of all, financing is cheap, right? Debt is super cheap. So if you want to get business loans, you can. And there's lots of different ways. And if we want to get into that, we can. But at the same time, like there's even like small business acquisitions. Like there's a site, a lot of people like, buy websites and stuff like that in like Flippa or those types of things. But there's a site called microacquisition.com, and it's designed for small acquisitions, something that's doing $100,000, something that's doing $10,000, something that's doing $1 million. And they're now trying to integrate actually with like things like AngelList, where you can actually get funding for that acquisition on the platform. So basically identify an existing business that may be profitable, maybe not profitable, but it has revenue and has a customer base. And if you're like a marketing genius and the person who started it is just like a developer who doesn't really know what they're doing, this could be like a layup, because you don't have to do anything, right? You're just stepping in and using your skill set to amplify what they've already built. So kind of like building and buying also goes to like, what are your skills and what are the skills that are missing in the existing business today? Like if you have the skill set or know where to get the skill set that is actually missing in that business, you can grow a business without having started super easy by just acquiring it.
That's very cool. I actually haven't heard of that type of platform before. And I think that could be very powerful, because we're connected more than we ever have been, in the past. And I think that's where a lot of entrepreneurs can find issues or, kind of hit a wall, is that they might not be that, marketing guru per se. And that specifically when it comes to kind of more like the online marketing, mobile marketing, where the world is going to. So that's solely for if someone wanted to say, I was an entrepreneur, I wasn't good at that, hit a wall with my company, maybe it does $1 million, $5 million a year, whatever it happens to be. So I can list that on that platform, and then someone who does have the know-how that might be interested in that can then acquire it per se.
Yeah. I mean, I think if you're in that 5 million bucket, right, and you want to acquire something, the real question is like, are you looking to bolt on, meaning like take down something that's like doing $500,000 to $1 million, or are you looking to like swallow something the size of yourself, right? Like go after someone who's a competitor type of thing. And so again, it would depend on the business, but I think that's the interesting thing when you get into business acquisitions. There's a period. So typically what you do is like you have a letter of intent. It's called an LOI. And you're like, hey, I want to, make an acquisition, or I want to buy your company, or whatever it is. Now there's also, before we even get there, like you can, kind of almost like in a casual way, ask someone, hey, are you interested in selling your business? And a lot of business owners don't even think about that, or at least, in the past, that wasn't a really common thing. Like, yeah, I intend to sell my business. So you can approach them in a casual way. Or sometimes there are places, right, they're already actively looking to sell, like Biz by Sell is a website type of thing like that. And when you get into, after you make a letter of intent, the way it typically works is that there's then a exclusive due diligence period. So the letter of intent basically says, hey, we intend to buy this for whatever, call it $5 million, right? And you get like 90 days to do due diligence and more or less kind of back out of the whole thing. You're generally not obligated. Like you're making a legit offer you have an intent, but there could be a million reasons why the intention doesn't come to fruition.
Right.
So in that due diligence period, yeah, you see the numbers, you see the financials, but you can also start to see the strengths and the weaknesses of that company and the players. And that can determine for you of like, okay, I see that they have exactly the same as us. Is that a good thing or a bad thing? Meaning, is a total overlap and we're going to have to let all these people go? Or is it amazing because now we could just leverage and basically I'm buying employees and customers? Or is it like they have totally different skill sets than me? They're going to complementary and I'm going to grow their business with my skill sets and they're going to grow my business with their skill sets. And we're not going to be a $10 million business. We're going to be 20, 30, 50, whatever it is. So, depending on like what that business is, how complementary it is and how complementary the skill sets are, you could, I was helping someone who wanted to be like in the more like tax advisory space. And what was interesting is like, we assumed like, we started looking at accounting firms to buy. And what we found was really interesting. And that was everyone who's selling these accounting firms, what they think the value is their customers. And so here's the revenue that they're generating from their customers. And the truth is like, that wasn't what this client of mine was after. They actually had no interest they didn't want 90% of the customers, because they focus on small businesses. They don't focus on what we call a 1040, like an individual tax return. And if you look at most tax practices, like accounting firms, like the small ones, we're not talking about the PwCs and Ernst & Youngs and stuff like that, but we're talking about like the regional small guys who maybe are a local office. 80% of their work typically comes from individuals who are doing tax returns in April. And maybe 20% comes from like small business owners or, small companies and stuff like that. And what my client really, really wanted was he just wanted the experienced staff. He didn't really actually want any of the clients and the customers. And so after exploring this for a little bit, we recognized that actually buying a competing accounting firm or a accounting firm in another country, another state or something, it wasn't what he wanted. He could just hire a recruiter and just start hiring employees who have experience. Maybe they're at these companies, maybe they're not, but it doesn't matter. Like he could just save a whole lot of money and just go hire employees who have the skills that he's looking for. So again, it's the evolution of like, why am I buying? What am I buying? What am I trying to get out of it? And recognizing in this case, hey, I'm overpaying because I don't really want I don't care for that revenue. And so I'm paying for revenue that I'm going to ultimately let go. That's a silly thing to buy.
That makes perfect sense. Again, it has to align with what you want, not just because you think that, this is what you need to do to grow. And I feel like that is a common mistake. And it's like what I do, I'm looking for a specific type of acquisition. There's a lot of apartment complexes out there, but they don't necessarily fit my vision of how I want to grow and the type of, return I want to provide my investors. I'm looking for a value add property, generally in the, B to C plus class range, and generally in a Sunbelt state. There's great, underlying demographic and fundamentals that's where we want to be. Now, I'm not at this time, I'm not looking for class A property that is going to yield substantially less. There's not really meat on the bone where we can come and improve the property because it's recently been built. And I think it's important to know what you want and focus on that. And we're looking for a certain type of income that the property is going to generate, whether that's now or in the future. And so I think that's super important for all entrepreneurs to know what do you actually want, and that's what. And if you focus on that, I think that's what can really help grow your business. But I guess my question is because you can either acquire it like we've been talking about, like an acquisition or a merger, or you can organically grow and scale. And in your experience, is there a type of person that is better suited for one or the other?
Yeah. So I was trying to touch on it before. There are people who are better fit for one or the other, meaning the starters versus the scalars.
Right.
And I think it comes down to, there are some people who are really good at execution, and therefore they're not necessarily a marketer. They're not necessarily a salesperson. They're not necessarily like a visionary, but they just get crap done, right? They just get in, and it doesn't matter what it is. Like, it could be the operations of a business. It could be the managing of people. It could be the writing the SOPs, right? Standard operating procedures of businesses. And some people will find that role very mundane and boring, while other people find that super exciting. And you have to kind of know whether you have certain skills or whether your team has certain skills. So the idea to, like, a lot of businesses I meet with, like, the owner is just, or the entrepreneur, however, whoever, if some of them are passive and some of them are active, the idea of growing scares them. And therefore the idea of like doing things that they're not comfortable with is not really interesting to them. They're like, hey, I'm in this kind of like zone. I just want the business to be more profitable. And so whether it's growing, building, or buying, they don't necessarily want either. They just want more cash flow to the bottom line of their business. And so I think the personalities are, there's a lot of these tests out there that you can take, all different types of personality tests. Like there's the DISC test, which a lot of corporations use. There's a Colby test. There's even like the personality tests of like I'm totally blanking on what it's actually called, but like 16 personalities. I forgot what, it's the ENF type of.
Oh yeah.
And
yeah.
And then there's the Enneagram, which is more of just like a personal thing of who you are. And that one has like 9 types. But all of these really will show you both yourself. And I don't say like, take a test and now you'll know everything. Not at all. But it gives you direction of like, are you a doer, or are you much more like a fact finder and you don't actually execute? Or do you do both, right? Do you do all the research and the fact finding and then you actually execute and you're a doer?
Mm-hmm.
And that will talk to like why you want to do, like how well you will do at some of these things. Because at the end of the day, like if you're like, okay, I want to grow my business, and again, not to be like all blah, 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 just know why, you do have to understand like, okay, if I told you can have a $3 million business or a $5 million business, you're going to make the same amount of money at the end of the year, like which one do you want? People will be like, that's not possible. Like the first response will be like, no. But a lot of times it's what happens. And so therefore, like, do you want to work harder because you want to go from 5, ultimately the 3 or 5 and the 5 person wants to go to 10. Okay, that's fine. But understand that muddy middle where you're not going to make as much money. Are you going to be okay with that? Because what's motivating you, right? Like, is it, I want to employ people. I say I'm solving this big problem, or is it like, no, I'd rather my bank account be, obviously people probably want all of the above,
right?
But kind of prioritize like where it is. And so once you do that, you also can look at your financials of a business and start to see like what's driving things. I think a lot of times like business owners get into things and they're like, either they're fixated on revenue or they're fixated on like costs and not understanding the relationship between the two, in the sense of like, when I spend the money, what is my return on that money from a both revenue and profitability standpoint, versus like, if I don't spend the money, what actually will happen? And that's, I think, another thing I find that like most business owners don't have a financial background, which is not a bad thing.
Yeah.
As long as you have someone on the team who actually can explain to you what the heck is going on in the numbers, versus just like, looks profitable to me, like you get your monthly P&L and you're like, oh, there, it's positive. So who knows, whatever.
Yeah.
And that's like, seems to be like a reasonable gap where people actually need someone to actually dissect their numbers and explain to them and say, hey, listen, if you keep on this path, you're going to be super profitable, or you keep on this path, you're going to have a real problem down the road.
Yeah. And I think it's always good to have a third party, hopefully unbiased third party that can take a look, because, it's just human nature. It's your baby. You're going to be biased and not necessarily see the whole picture. But I think your point on, are you a doer? Are you an executor or not? I think that is a great point. And what really changed my business is when I really sat down, because any entrepreneur at the beginning, you're wearing a lot of hats. Maybe you're even wearing all the hats at the very beginning. But I think you really need to look and see what you're good at, and 2, what you actually like doing. And then surround yourself with people that are good and like doing the things that you're not good at and you don't like doing. And so when I did that, and I brought on my partner who's more of the doer slash executor of the small monotonous type things that just kind of, annoy me, for lack of a better term. He's phenomenal at that and he loves doing it. He's really good at it. And so once we separated that, and that's what he focuses on primarily, and I'm more of, 30,000 feet vision, relationship stuff. Once we did that, it's just exponentially grown. So I'm glad you brought that up. I think that's important in anyone that's in business to identify that and then surround yourself with the people that do the stuff that you're not necessarily great at or like doing. But I want to touch on the profitability point that you brought up, because I know that's something you also help clients with is when they want to exit. What does that look like, and what are kind of some tips that people should look for or should be implementing, and what are kind of some of the I guess like the failures or the faults that people make?
Sure. Yeah. So that's a great multifaceted question there. I think the first and foremost is, if you think that it's potentially ever going to be on your radar of selling your business, exiting your business, planning for the future now is way more important than you think. So I think a lot of people, go under this assumption, especially because like what you see, whether it's in the news or whether you see it's on social media or whatever it is, when someone is actually going to buy a business, they don't only look at the last 12 months. They generally want to see 3 years, maybe even 5 years. And the longer you've been in business, the more they're probably going to ask for certain things. Meaning, if you make your last 12 months look all nice and shiny from a financial standpoint, they're going to want to see additional information. And if years 2 and 3 in the past were a mess, but you made your last 12 months look pretty nice, they're going to recognize that, and that will impact what they're willing to pay. So you generally see people, it's very interesting when I try and explain real estate to people, I use these analogies, and that is, when you buy a business, you generally are taking either, depending on the type of business and the growth of the business, you either use what we call like a revenue multiple, meaning I take the revenue that the business is doing and I put a multiple on it. So a 1 times, a 2 times, a 3 times, whatever it may be. Or the more traditional way is that we take the profitability line, right? Or in bigger businesses, we use the number called EBITDA, which is just earnings before interest, tax, depreciation, and amortization. A lot of businesses, the net profit is very similar to the EBITDA, but like if you have a company that has like heavy machinery and equipment or lots of assets, even in real estate, right? Those things depreciate. It's a
Right.
function of an accounting thing, but it's not actual cash. And so we take that number, think of it as like the profitability number, and we're going to put a multiple on that. And so whether it's 5 times, 6, 7, 8, 15 times, whatever it may be. And again, depends on the industry, depends on the growth, depends on all these things. And so I think a lot of people make the mistake. They're like, okay, I had a great year. Let me go sell my business. And they think they're going to get whatever 5 times earnings. But last year, their earnings was a fraction of that. And they're like, yeah, but I have a great business now. Well, guess what? The person's going to look at the prior year as well and try and understand that. So first and foremost, kind of getting out in front of it in the sense of like, don't sell like because you have to. Like anytime you're in a forced situation, you're obviously going to be at a disadvantage, both from negotiation, for valuation, all these things. But the other thing is that like that goes to profitability in the sense of, yeah, I get it. Like if you're building Amazon or you're building some massive tech company that you are like, hey, we're not profitable today and we're burning cash because we see this big time upside and future. That's a whole different conversation than like your average entrepreneur who's running a $1 to $100 million business. And, they're kind of like, hey, we do need profits. And I think that it's just like a misconception a lot of times where people are like, well, I don't have to think about profits now. I'm thinking about growth. And you can think about both. So here's an example. If your business does $1 million of profit and we gave you a 5 times multiple on that, right? By definition, we were saying, okay, we're going to pay you $5 million for your business. If you had taken like the last year or two and said, hey, we're going to be a little bit more profitable, we're going to be 10% more profitable. So instead of having $1 million of profit, you have $1.1 million. So on an annual basis, you're like, whatever, it's $100,000. It's nice. It's 10%. It's not, whatever. But if you extrapolate that into the exit, it's going to be $500,000 to you. It'll be that same 10%, right? So they'll pay you, let's say that same 5 multiple, but it's going to be on 1.1 versus just the 1, right? So getting an extra $500,000 on that sale, that sounds a lot nicer than like focusing on, 10% margin increase. And now sometimes 10% is a huge number. So like make it 2%, 3%, whatever it is, someone is going to give you on the business exit a multiple on that number. And so that's why, like, when I talk about real estate, it's inverted, right? In when we buy, in your case, like you're buying apartment buildings, or we're looking at apartment buildings or self-storage, right? You take the net operating income, which is effectively the same profitability line, but instead of multiplying it by a multiple, you divide it by a cap rate,
Yep.
right? And so in business, the higher the multiple, the higher the value you're going to get, and the more money you're going to put in your pocket when you sell that thing. Whereas on the real estate side, right, like the lower the cap rate, the higher the value. So it's like a little bit backwards, but that's because it's a multiplication versus a division kind of equation.
Yeah, and I try to, paint that picture to both listeners of the podcast and also investors, is that, we're buying, you look at it and you see an apartment complex where people live, but what we're essentially buying is a business. Every apartment complex is its own business because it's got employees, it's got a top line, it's got a bottom line, and we're trying to increase that top line and be as efficient as possible to, either, to reduce those expenses or at least maintain them at a, comfortable level. And yeah, exactly. Then you get the net operating income, and then based on your market, there's going to be a cap rate that applies to it, divided by that, and that's going to give your valuation. So yeah, that's how we do things, and that's where we're creating the value, because like I mentioned before, we're looking for a certain type of property that we can, bring value to drive that top line, obviously be efficient on the expenses, so then it also hits directly to that bottom line, and then you apply that same cap rate and you can make, a good amount of money for your investors. I think that's really important, this whole, how you mentioned thinking about this earlier than you think you should. And it's just like your point of, you had a really good 12 months, so then I want to sell it at that. It's kind of like what brokers do to us when we're acquiring a property. Is sometimes they'll send the T3 or the T1, and listeners, that's just the trailing 3 months or 1 month for the income statement. And yeah, of course, that's going to paint a pretty picture if they've been, increasing rents and occupancy. But no, I want to see the 12 months, and then even once that seems like it might be a good deal, I want to say even further. So yeah, I think that's a great point. Everyone has to be careful with that.
Yeah, and even if, like, into your question originally, right? Like, you may never sell it and you may never want to.
Right.
But if you kind of get things going earlier, start thinking about, like, what does the buyer want? Like, I typically say, like, there's two categories of buyers. There's strategic buyers and there's financial buyers. A financial buyer is looking for a financial return. So if they buy your business for $5 million, number we've been using, ultimately they're going to want to exit that business for more than $5 million, or take cash flow, like a real estate investment, along the way, plus get their exit, like, at an increased value later. So it's all financially driven. Whereas a strategic buyer may be a lot of what we talked about earlier, and that is, it's a complementary business or a bolt-on business to someone else, where they have economies of scale, they have, cost efficiencies, where they can just plug your business in and strip out a whole lot of the costs, because they already have a lot of that infrastructure for their business. They are looking at it from a different perspective. It's not about just financial gain, and they're probably not looking to flip that business out. They're looking to enhance the existing business. And most of the time, a strategic buyer will pay more than just a standard financial buyer.
Right. That's a good point too, because yeah, they have the systems and processes in place, and they know how they can run it more efficiently than maybe that business owner was doing before.
Yeah, just like your buildings.
Yeah, exactly. Because we know what, like, we'd look at it per unit. So on average, right now in today's market, generally salaries for the complex are going to be about, $1,200, give or take, $1,200 a unit. And so you might be looking at a property where theirs is more like 14, 15, and you're like, well, I know I can run it way more efficient than that. And there might be many reasons why it's higher. Could be
Correct.
Maybe it's a mom and pop, maybe they're employing a family member or something, and that doesn't really need to be there. So
Right.
That's when you dig into those things. But yeah, exactly. There's, and once you grow, you like a strategic buyer, these things, you're more intimate with these details, and that you can come in and produce that outcome. No, this has been a great episode. I can't even believe we're probably at like 40, 50 minutes. I could talk about this topic forever. One last question before I get into my last round of questions, and that's,
Sure.
So you mentioned you should get into thinking about, like, what's your succession plan, what's your exit plan, and earlier than you think you should. In your opinion, like, when is that? Is that from the very beginning? is that once you get to a certain level? I'm curious myself.
Yeah. So I think in general, right? Like most people don't do it in the beginning, but it doesn't mean they shouldn't. I always say like start with the end in mind in the beginning, right? Like if you have the vision, and it can change. You can totally change your plans, but think about anything, like with a GPS or Waze or any of these things, right? Like if you're in, for example, you're going to take a look at a property in Oklahoma. You land at the airport, right? Whether you get an Uber or you rent a car, you have no idea exactly where that building that you're looking at is, but you know that end destination is the building.
Right.
So you put it into the GPS or the Waze or whatever you use, Google Maps, and ultimately it says, okay, here, you're starting here and you want to get here. Let me tell you how to go. So it's the same thing when you start the business, like you have to have some sort of vision of what you want. It doesn't have to be perfect and it can totally change. But then you're starting here and you're trying to get here. Okay, so what are the steps I need to do that? And so some of it is like there are just incrementally valuable things inside your business of thinking about the exit. Yeah, the profitability is one of them, but I touched on it for a second before, like the standard operating procedures, like these SOPs. And you said you have a person who likes much more of that, the monotonous, mundane things. These, if you can build frameworks like for repeatable business, and it's not all sitting up in your brain, a buyer will say, hey, that's scalable. Hey, that's useful to me. I can do something with that, as opposed to, oh, I don't know anything about your business. How am I going to learn? You'll be like, okay, I'll sit by side next to you for the next 6 months, right?
Yeah.
Like you're not interested in that. They may not be interested in that. Like just, those things are important. How you actually deal with in your case, like your investors or whatever it is, where are your contacts? Do you have a CRM system? How do you think about the future growth? How do you do you have dashboards to actually know your metrics? Do you know your KPIs? All these little things where like in the beginning, people are like, I don't even know what you're saying. Like these are acronyms I never heard of. Yeah, but that may be that, okay, in order to grow and in order to be thinking about that future, you need to actually start to explore like, how can you run your business better and ultimately make it interesting for someone who would step in, buy, take over, whatever it is. So again, to your succession or exit. So, and again, it can always change and you can reevaluate it every 1 to 3 years or so, or whatever it is. And, I think this point is also like, can be extrapolated for, when people think about their liquid net worth, right? So not their business net worth, but the net worth that they have in the bank or in investments and all these things, right? Someone is generally managing that, unless they're doing it themselves, someone, whether it's yourself or someone else, right? Like you're managing the real estate side, this guy's managing the investment side, whatever it may be, the stock market side, this guy, that, whatever. The business worth, though, of that person may be their biggest asset, may be the most valuable asset. And someone should be mining that every 1 to 3 years, like meaning like paying attention to both what it's worth, where is it going, how's this going, because that may be the exit strategy for their future. That even if they don't sell it, even if it's a succession plan to the employees or to their children or whatever it may be. And it's something that I think people just don't think about enough, that yeah, there may be a cost in hiring someone to independently value the business, but that's fine because you pay someone to manage your investments. Why wouldn't you pay someone to pay attention to your business? It's just like you have a lawyer for your legal agreements. It's, you have an accountant to do your, file your taxes and what have you. Same kind of thing.
It's such a great point. I feel most business owners, like in the kind of situation you were speaking on, they're like, yeah, I'll worry about that once we get to that, point, that exit. But in order to get to that point in that exit, you need a roadmap to get there, at least to get to the destination you want to be at. And we do that with the apartment complexes we acquire. It's not like, oh, I'm buying this apartment complex, I will worry about what we need to do when we want to sell it in 5 years or so. No, it's like I'm buying this because I know what I want to do in those 5 years, and this is what I need to do to get there. And does that work? And if it does, okay, let's pursue it. Yeah, and that's a great point. And not only do we need to think about that with each acquisition, but the company as a whole. Yeah. That's a great conversation. we could probably just have an episode just on this, but I need to let you go because we're getting up on an hour here. So I guess my last question for you is I ask most guests this, is that if you could go back, if you had a time machine, you go back in time to your younger self, the younger Aryeh out there flipping cards, what would be that, if you give yourself one piece of financial advice, what would that be?
Ooh, so I have kids. So I while I don't get to do a redo for me, I definitely try and give it over to them now. And the number one thing I would say is, like, just because you know something doesn't mean you're actually doing it, right? Mm-hmm. There's the intellectual side that says, okay, I should be investing $100 a month into whatever it is, or I'm doing my 401k, that's enough, or whatever it is if you're an employee. Or, take an example. And that is, like, I would say do everything as early as you can. Start, make those mistakes, make those investments, make whatever it is. Because as everyone knows, like, we never get time back. We can always make more money. We can always replace, a car, whatever it may be, a house, but you'll never get the time back. And so I think I would have done certain things that I knew to do, and I may not have done every single one of them. And, I could have done better. And at the same time, like, I think I've come to realize I appreciate my time much more, and, recognize that, like, you're not going to get that back. And, like, I know, today someone's 20, 30, 40, 50, whatever it is. Everybody after they're 25 or so says, oh, if I could have one more year back, or if I could go back and redo things. And that kind of goes to also the last point I would probably say is, like, if you are concerned with, like, should you do this thing? Should you not do this thing? Like, bet on yourself, like, invest in yourself and bet on yourself, because it will probably yield you the best returns. And the self-doubt that you have will be way, overcome later by actually doing that thing, whatever you're unsure about.
I love that. That's great advice. Well, before I let you go, where can the listeners find you?
Sure. So I would say if they on social media, Instagram is probably the platform I'm the most active on. So that's Aryeh the Businessman. And then the two sites I would say is futurefundme.com or solutionadvisory.com.
Awesome. Well, Aryeh, thank you so much for your time. This has been a wonderful episode. I might even go back and listen to it myself, because there's some great nuggets in there. But yeah, thank you so much for your time, and thanks for coming on.
My pleasure. Had a great time.
All right, listeners. Well, thanks for tuning in as always. Like I said, you should probably go back and listen to this as well and take some notes and set up your future in the right way so you can achieve that life you want to live. All right, everybody, take care. See you on the next one.
Hey, this is Sean Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.